Welcome to the Main Street Journal. Today, we're diving into a crucial topic for accountants and small businesses alike, the new Compilation Standards. In 2021, CPA Canada rolled out a significant change, a new standard for compilation engagements. This update is more than just a tweak. It means increased work and potentially increased fees for practitioners working with small business clients. Historically, compilation engagements were known as notice to readers. Now, that's being replaced with a, quote, compilation engagement report. While they may seem similar at first glance, there are subtle yet important differences. The old notice to reader was straightforward. Based on management's information, the accountant compiled financial statements without performing an audit or review, expressing no assurance. The new compilation engagement report includes management's responsibility for accuracy and completeness and explicitly states adherence to Canadian Standard on Related Services 4200 or CSRS 4200. So where are the real differences? Three main areas stand out: the practitioner's review of the information, management's determination of the accounting basis, and required documentation. Under the new standard, practitioners must consider whether compiled information, quote, appears misleading, a stronger requirement than the previous plausible standard. This demands a deeper level of review. Management must now determine the basis of accounting, which often means practitioners need to educate clients on options. Plus, a new Management Acknowledgement of Responsibilities letter replaces the old Representation letter. For most small firms, these new standards are proving to be more of an annoyance than a substantial change. They introduce additional administrative burden without necessarily adding value for tax purposes. Practitioners are now expected to explain complex accounting standards to clients who often don't understand them, and then reiterate that these assurance standards are largely irrelevant for tax purposes. The CRA's stance is clear. The Income Tax Act doesn't mandate specific accounting principles for determining profit, allowing any method consistent with the Act, case law, and well-accepted business principles. The author argues that these new requirements might be a way for professional bodies to maintain relevance as the importance of traditional audit work declines. Traditional audit work is becoming less important as entrepreneurial companies in Canada are going public less often. This shift impacts the core business of many accounting firms. With 13 regulatory bodies in Canada billing an estimated $780 million, they need to ensure they maintain their significant position in the industry, even as the landscape changes. A compelling argument is that the new standard effectively blurs the lines between assurance and non-assurance standards. By requiring practitioners to quote CSRS 4200, even when no recognized standard is used, the lack of a standard is elevated to a standard itself. This means that anyone issuing a compilation engagement report in BC, for example, could inadvertently become subject to regulation by CPA BC, even if they are not members. Non-members might find it more appropriate to stick with the old notice to reader or simply attach a notice that financial statements were prepared by management to avoid potential sanctions under CSRS 4200. The author remains skeptical, suggesting that the CRA often does a better job of protecting the public from inadequate tax practitioners than the accounting profession's own file reviewers.